Yep. And be sure to get some food. All right, can you all hear me okay? Too loud? I'll try not to yell. I'll remember that I have a mic on. No. So you got to think, normally I'm talking to like 50, 60 kids outside who are running around all at once. Not all my kids. This is my trail life troop. Only 6 are my kids. So I do a lot of yelling, so I'm going to try and tone it down since I do have a mic today. All right. We're going to go ahead and get started. But show of hands, and you can be honest, this is a safe place. How many of you have a copy of your own promissory note that you signed? All right, I got like 4 of you. 5. How many of you read the entire thing when you signed it, or you just went, I need the student loans, I'm just going to sign it? Most of you did that. Okay, I know one person in here has already claimed to have read every single line of this thing. I'm going to be honest with you, we are not going over every single line of this thing. We don't have time in an hour. We're going to hit the important parts, what I consider to be the important parts. All right. So, we're basically going to go over now what you said you read when you signed it. Okay? Important stuff in here. For those of you getting a little bit closer to the end of your medical school career, first, thanks for coming in. It's nice to see y'all. Haven't seen you in a year. There's some good protections in here for y'all, and then for the rest of you as well. But there's also good information. You just need to know what on earth you signed. I'm going to tell you up front, especially for those of you coming to the home buying workshop next week, read every line. Be that annoying person at the lawyer's office that reads everything. Until you've done about 1 million of them, you don't know what all's in these documents. So you need to take care of yourself, protect yourself. You are entering into a contract, and there's some huge issues if you default on this contract. So, again, we're not going to cover absolutely everything. We're going to hit the things I think are most important. Some of it's actually redundant. They hit the same topics again and again, with good reason, because they hit them in greater detail. And I would recommend looking over it. But, again, some of it we're skipping entirely because tomorrow we have a whole nother session on loan repayment. We're going to go through all the different loan repayment structures that the Department of Ed has set up that are currently available. And before any of you start asking about, well, what about the new proposed one or this new proposed one? Well, they're not passed yet, so we're not talking about those yet. And I have already gotten questions about the one that was proposed at the same time as they did the loan forgiveness proposal. That one wouldn't apply to y'all anyway because it only applies to undergrad. So if you're hearing much about it, y'all ignore it. Plus, we'll see just what happens. So what is a promissory note? Who wants to take a stab at this? And I don't need the textbook definition. What would you say a promissory note is? A promise to do what this paper says. Which one of these things do you want? I actually brought prizes today.
I'll take a clear one.
The clear one, U.S. Army. All right. Prizes run out when they run out. So it's literally a promissory note. It's the same as your mortgage. It's the same as your car note. It's, I promise to repay this money. So what makes this a master promissory note? Because it is a very different type of note. Anyone have a guess on this? How many of you borrowed before you got to medical school? A lot of you. Did you have to sign another promissory note when you got here? Okay, I probably told you to because it's just easier that way. Strictly speaking, you didn't have to. The one you signed originally was good for 10 years. That's what makes this a master promissory note. So because it's good for 10 years, it's good for any loans you take out under this program. And the one you've got in front of you is the direct unsub and subsidized loan program. Same one many of you signed in undergrad, same one you signed in your master's programs. Different from the Graduate Plus loan program. I didn't print that one, but it's almost exactly the same on there, just lists how the Grad Plus is different. Also, they're both like 14 pages, and I already killed enough trees today. So it's good for 10 years. All right, bonus points. Who can tell me who is on that picture up there? No, that is not William D. Ford. I obviously have no Doctor Who fans in the room. This is the Master from Doctor Who. The Master, Doctor Who. Never mind. Y'all disappoint me. You know, it's like the Doctor can regenerate, so can the other Time Lords. Anyhow. All right. So now we're going to pretty much go straight through this. There's one part we're going to skip and kind of go back to. Borrower information. This is the whole first section you filled out. You want one? Copy of your promissory note? Well, not yours, but a copy of a promissory note. And get food. So borrower information. Why do you think they need your borrower information? Exactly, so they can find you. They're giving you money. I mean, they want it back. It makes sense. And you can't borrow these loans without filling out this information. Most of y'all did this online. You wouldn't have done the paper application, although legally it is still your right to be able to do a paper application. So we get into the whole second section. And by the way, all of these things have line numbers and everything. So references for the same exact reason. Well, we couldn't get you at the phone number you said you had or the email you said you had, and you weren't at your address because we showed up there looking for you. They typically don't actually do that, but they will send a lot of letters and whatnot. And they'll go, okay, who else can find you? And that's who your two references are. They recommend that one of them be a parent or guardian. It's not a requirement, but it is a recommendation because typically they expect, well, we bet your parents will be able to find you. They got to know where to send that Christmas card or whatnot, or whatever the case may be. And then the other one has to be someone you've known at least 3 years. So when you filled this out, hopefully you didn't put like this new roommate that you just met 5 days ago while moving into medical school. If you did, obviously you didn't read it very well. But they're going to hunt you down. And we'll get to some of the disclosures later on in this that goes over some of their powers that they have to hunt you down. So you can know what you actually signed. Sorry, you already signed it. It's a little too late to get out of those things. It's not honestly too bad. All right. So then there's the school information. This actually got auto-filled when you picked the University of South Carolina. But they send it to us. If they don't send it to us, or if we don't know you've completed it, I can't give you money. When I worked at our main campus at USC, it was right when we got into using this new program called Common Origination and Disbursement at COD. It's about like the nasty fish it smells like, or it sounds like. And we'd have an issue a lot of times where students were transferring in, or you were coming into medical school and things like that. And for some reason, we wouldn't have your promissory note, even though you signed a Master Promissory Note maybe 2 years ago when you started a master's. Well, that's part of the reason, my experience with that, why I inform all of y'all, hey, go ahead and sign a new promissory note when you get here, even though it's not strictly required. So that we get it, we can link it with the loan that you've accepted. And some of you may have even experienced issues with this in the fall of your first year where we're like, hey, we can't figure out why exactly, but your promissory note is not here. Just go sign another one. You're like, Casey, I've signed 5. 6th time's a charm. I don't know why, but it is. All right. So now we're going to skip, if you're wanting to kind of follow along. We're not going too far, but we're going down to the signature page. Because when you're signing it, you're actually signing in the promises section. Promissory note, promises. They make promises. You're making promises. They're making promises. So if you're looking at it by the line item, line 16 is I promise to pay what? What I borrowed. Principal. I promise to pay all the interest that's accrued based on that, which, hey, good for y'all. Good time to be in medical school. No interest is accrued in the last 2.5 years. Maybe, are we up to 3 years now? I don't know. But we're talking huge savings for y'all. That's not been the case for 90% of my career. So you're promising to pay the interest that will supposedly start up in June. We'll see. I've given up predicting and listening to them when they say this is the final time. It's like those parents that you're out at the trampoline parks and they're like, I'm telling you, you come here. This is the last time I'm telling you. And 5 minutes later, they're saying the same thing again. That's what the Department of Ed is, and the administration is right now on the interest restarting, which I'm good for y'all. It drives me crazy when I see parents do it, but when it comes to y'all's interest, I'm more than okay with this. It also means that you're going to pay any fees. Some of you already knew about this. Some of you haven't paid much attention to how much you've borrowed and how much actually disperses on that. There are fees taken out by the Department of Ed. On your unsub loans, they're 1.068%. For some of you, you started when they were 1.069, so they've reduced a little bit. Congratulations, you've made like an extra penny. And then if I don't pay, they can charge me late fees. That's what line 17 is basically saying. They can charge me late fees, they can charge me collection fees. Yeah, and reasonable is in the eye of the judge. Yeah, so just simply don't default on your student loans is my best advice, and we'll come back to that later, but I will tell you, hint, hint, if you default on your student loans, you can lose your medical license. Not kidding. It's grounds for losing any professional license that you have. On top of that, they will also garnish wages and tax returns and show up at your house. All right, so line 18. You said you read this whole thing. Did you read line 18 and did you get a chuckle out of it?
I might have laughed 2 or 3 years ago.
Yeah, this is, in the I have read and agree, this is my favorite line here. I promise that I will not sign this before reading the whole thing. Yeah, even if Casey's sitting here saying, just sign it for the love of all that's holy, sign it so I can give you your money. Don't read it. You're affirming that you are reading it even though you were told not to. I would never actually tell you that. I told you up front. If you're borrowing money, read the dadgum contract. Yeah. And then line 19. By signing it, I agree that I've read all 14 pages. You are asking me to explain the thoughts of bureaucrats. I have no clue. I really don't. Now, I will say part of it is because that's like the active section of the form, if you want to call it something. Because after that, it's just a lot of explanations and things like that. And you get into terms and conditions, which means we're actually going to define the terms that are in this. Like one of them, it says, every time we talk about we're talking about the federal government and the Department of Education. Every time we're talking about school, we're talking about whatever school you are. Every time we say you, we're talking about, well, you. And then my favorite one that very few people would know much about, every time they're talking about the act, does anyone know what they're talking about? Does anyone know what federal bill they're referring to and where your financial aid comes from? This is like bonus points here, if you can get this. Is your hand up or are you just holding it like that? Okay. Gotcha. No, not Sally Mae. It is the Higher Ed Act of 1965, and then they would always add as amended. Currently, it is far out of date and has been overdue for an amendment for the past 8 to 9 years. So they just handle it by continuing resolution. That's why you've not seen any major changes in financial aid in the past few years. Congress can't agree on anything, which again, in some ways has actually worked well for y'all. But in other ways, it means that some of these really great proposals that we've seen coming out haven't been able to move forward because they've not actually been able to get through a reauthorization of the Higher Ed Act. Anyhow, that's a whole nother topic. All right. Come on. What did I do? I don't know what I did. I'm not trying to save anything. All right, now we're going back to that part we skipped, items 12 through 15. So, this is what you're asking. This is what you're signing to get. So, you're promising to repay. Well, this is what you're promising to repay, and this is what you're requesting. Because contracts are supposedly two ways, at least in that you can freely enter into it. So, the borrower requests certifications and understandings. Line 12, I request a total amount that cannot be more than I'm eligible to receive. And then there's more in there, but what it's basically saying is if the school screws up and gives you more than they're supposed to, yes, it's the school's fault, but it's on you. And so you're saying, I'm not going to receive more than that. Now, good news. That doesn't happen here. It's really more of an undergrad thing. We find it with like students moving from first to second year, like, oh, you had 29 credit hours. We automatically bumped you up to a level 2 because that's 30 credit hours. We saw you were taking some summer classes. Oh, crap, you failed those summer classes, and we gave you too much loan money for the fall. We've now got to reduce it. Truth be told, dude, it gets fixed, and usually without the students ever even knowing it. But ultimately, it's on y'all if the school overpays. And if you have an overpayment, this used to be one of the things I did at the main campus, we'd have to go through certain students' NSLDS records, National Student Loan Database records, and if they had an overpayment, we couldn't give them money until we got them to get a statement from their school acknowledging that, and a statement from the student acknowledging that they would repay that overpayment. So I couldn't continue to give them financial aid because another school screwed up. Well, that's the same thing. Y'all are going to be pretty immune from that, but just so you know, it's in there. All right. I also certify this first one, one, that it's true. Everything I'm putting in this application is true. Well, I would hope so. It's not a good idea to try to defraud the federal government. They've got more money than us, even though they took it from us. And they can tend to come back at us when we try and defraud them. Line B here is the one that if you've ever mentioned the word, Casey, I need a car, what is the next thing that has come out of my mouth? Does anyone have an answer to that? Pretty much, I didn't hear that. Or, I legally have to tell you that you cannot use financial aid to buy a car. And then I say some things after that we're not putting on a recording. But we start out with that. So you're legally saying that when I certify this, I'm not going to use my loan money in fourth year to go on a fun trip to Vegas. I know how cheap travel got during COVID. Yeah. Just saying. All right. Again, I'm certifying that if I've received too much money, I have to make arrangements to repay them. That if I'm default, I have already made payment arrangements. Because guess what? If you default on federal student loans, if you make 10 consecutive payments, you can actually start getting federal student loans again. Don't be that person, but hey, good news. And that if I commit fraud, or if I've already committed fraud and defrauded the government, I've already repaid those loans. So you're certifying all of these things, even though we're actually going to verify that on the back end. All right. And then we get here, authorizations. Yeah, we've got to get all the correct titles. I authorize my school, the Department of Ed, to share all of this information. This is where I said that if you disappear on these student loans, they're going to do everything possible to find you, and they're going to be, hey, so-and-so's mom. Yeah, your loser son or daughter just defaulted on their student loans. They owe us, we'll pick our school average, $168,000 plus interest. And now, because I'm having to spend time calling you, I'm also going to charge them late fees. Help us get in touch with them so that we can help them out. And that's exactly how they'll say it. And by the way, it's not like when your medical bill or your credit card bill goes to collections and you can settle for less than you actually had, which is still not recommended because it's going to kill your credit. That's a different presentation. With the federal government, you're going to pay the full amount that you borrowed, the full amount of the interest, the full amount of the fees, and the full amount of the collections. Again, just don't do it. And you are also authorizing them, this is where they get the annoying part, to contact you by basically any means possible, including robocalls, auto calls, and all those hang-up calls that are otherwise illegal for telemarketers to do. You've given them permission already to contact you and do all of those really annoying things. And if you block the number, by the way, they're really smart. They have a lot of numbers. Some of them look local. All right, so next one. I understand, or at least I said I read this and whatnot. This is the school saying that, or you saying that, I understand the school's going to apply this money first to my bill. and then anything else is going to come to me. And that, and let me make sure I'm reading it right, or I got the right one. I can pay interest while I'm in school at any point. Just no penalty to doing so. But that if I don't, I love that the promissory note says this. It says the Department of Ed may capitalize your interest. We'll go back to that in a bit. It may capitalize your interest. Y'all, there are set points where they capitalize your interest. It's just going to happen. If you have no clue what I'm talking about, remember your confusion. We're coming back to it later. It also says that the Department of Ed can verify everything that I put on this form. That's why schools are obligated by law to check certain things before we give you money. That the school will handle my loan eligibility and let me know about it. Basically, it's saying, we've got a joke in the financial aid communities where we get calls from random students or parents who's like, I called FAFSA and they told me this. Okay. Did you read the promissory note you signed? It said the school handles your eligibility, not some person being paid minimum wage to work for a government hotline. So that's why the school is telling you that as a first-year medical student, you qualify for $42,722 in unsubsidized loans. As a second year, $44,944, so on and so forth, until you graduate. Because we're obligated by law to be the ones to determine your eligibility, not the Department of Ed. You can call them all day long. They can explain the promissory note to you, but they can't tell you how much aid you can get next year. For fourth years, the answer is zero. For everyone else, the answer varies. And it also, Line E is one that's relatively new. It wasn't on my promissory note. It has been on y'all's for a long time now, but very important one. You have already received your money. You have the right to cancel that money within 90 days of us dispersing it. And by canceling it within those 90 days and doing it through the proper channels of sending it back through the school, you not only reduce your principal by that, you also get backdated any interest that might have accrued. You get back any fees that were charged against you. So if you have money that you've received too much of, send it back through the school. By the way, added protection there by sending it back through the school. If an emergency comes up, you can borrow it again. If, on the other hand, you just pay the money directly to your servicer, yes, they're still technically supposed to credit your interest and your fees and everything back to you, but the school gets no record of that. So we show that we dispersed your full amount of aid and that you have no remaining eligibility. There's no way for us to get that back for you. But again, go through the school, you're good. You can borrow it again. Line F, that's kind of the master section of this. That's what makes it a master promissory note. And that I can get a copy of this form at any time. Your homework assignment. Go download a copy of your promissory note. You go to studentaid.gov, you log in, same place you did your FAFSA, your Grad Plus request, your insurance counseling and everything. And you go to My Documents, download a copy. Add it to your CYA file. Cover your rear end. Everyone should have a CYA file. This is why we do things with lots of written documentation. Any of you who have ever requested that I increase your loan, what did I say? Send me an email, include your ID number, all those sorts of things. That's my CYA. It's also yours because we have it in writing. Like, you requested this. It came from your university email account, sorts of things. All right. So now I said we'd come back to capitalization. Okay. Let's define some terms. You probably already know most of these. Principal. What is your principal? It's on the screen. What's your principal? The amount borrowed. You were the first one I saw. Do you ride or run? These are lights. Do you ride or run? I can toss you a light to wear while you're out. Or I can give you a water bottle. Water bottle? All right, fair enough. Look. These are actually great. I give them to my kids for when they're playing around in the dark, especially this time of year. All right. Interest rate. What's an interest rate? Exactly. It's the money it costs to get a loan. I'm giving you one of those just because it was easier to throw. And then the interest, of course, that's the amount charged. They charge a rate against your principal. That's the actual amount that you're charged. So in a normal time frame, this year, you guys would be accruing 7.31% on all of your unsubsidized loans in interest. That's per annum, so every year. So here's our example. Oh, capitalization. Yeah. Can someone translate that to English for me? So what does it mean to capitalize interest? Who already knew what that was before you came in here? Kind of? Okay, I'll take a kind of. Pretty much. That's the easy way of thinking about it. Although it's no longer interest at that point. Yeah. Not fun. All right. Lighter water bottle. All right. Sorry, you get the smeared one. That's why they gave me some of these. That one works. Yeah, pull the tab. Yeah, they've got flashing red lights or they've got the white light. It's kind of nice. All right, so here's your example. The student on the screen here is someone who actually borrows slightly above our class average for the last graduating class. This student basically borrowed their unsubsidized loans, and only their unsubsidized loans for the 4 years they were in medical school. That's 42.7, 44.9, 47.1, and 42.7 again. That's exactly what it comes out to. So at graduation, plus 6 months, their principal is still what they borrowed. On the other hand, they've accrued $23,000 in interest. By the way, this does actually account for the fact that this student had access to the administrative forbearance. So the data file I used was a few years old, so it only accounts for like 1 year of that savings, just to hopefully set some of y'all's minds at ease a little bit more. But anyhow, so this student accrued $23,000. They are now at the end of that 6-month grace period and are technically entering repayment tomorrow. So based on today, what you see there is accurate. What happens tomorrow? So now it's tomorrow. What's their new balance on their loans? What's their principal balance? 204.90. Guess what? They have zero interest again. Congratulations. But it's interest on top of interest because now they're going to charge the same interest rate on the new higher principal. So that's why when we talk loan repayment, and we'll do this tomorrow, this is why I have y'all make payments while you're in residency, even though it might hurt just a little bit. I mean, one, we can get a lot of credit towards public service loan forgiveness if you're going that route. But the other side is we want to stop your interest from capitalizing because you can't stop this from happening at least once. It's going to happen when you enter repayment. Unless you bought the winning ticket last night, I can give you my bank information. But I don't think you'd necessarily be here if you just won $1.3 billion last night. Still showing up to this. You wouldn't have come for the free lunch. You'd be like, Casey, I'm sorry, I'm skipping it. I'm getting a steak dinner. Or whatever your lunch of choice is, at the very least. Anyhow, so if you don't make payments while you're in residency, they are going to capitalize your interest every single year. So instead of it happening just once, it'll happen minimum 3 to 4 times, actually 4 times, because for each year at the end of residency. We are not talking about that tomorrow. We can do a whole nother session on that, though, if you want. We do hit it during the 4th year mandatory meeting. So, yeah, that's Sam McBride does a better job of that than I do because he's more in the private market, and he also is able to dive into the different lenders for refinance than I can. On the other hand, I can talk about not refinance, but consolidation a little bit, and we will touch on that tomorrow. All right, so that's capitalization. That's why it's kind of a big deal that even though it says they may, they absolutely will, and why it's going to cost you some money. Necessary evil, but one we can avoid happening more than once. All right, so what are your terms and conditions on this loan? I'm going to try and not bore you to absolute death on this. It's not a whole lot of here. It gets real repetitious when you actually read through this. The Act, again, that's the Higher Ed Act. That's why I asked you earlier, because I didn't want to give you the answer yet. So anytime you're reading that, that's what it's hearkening back to. It gets real confusing if you were to try and go read the law, because they've amended it about 15 times since then and then done continuing resolutions since then. Maximum eligibility period. This is one that is relatively new. Again, it didn't exist when I borrowed. It's that you only have 150% of a normal time frame to finish your degree. So what's a normal time frame for medical school? 4 years. Okay, so what's 150% of that? 6 years. So you've got to be done in 6 years worth of classes. Now, there's different interpretations of this, because the question is, how does it apply to leave of absence? Different schools apply this differently. Historically, our school has applied 150% from the time you start school till the time you graduate. You must be done, irregardless of the leave of absence status and things like that. So, need to know how that's interpreted. Interest rate, again, we've talked about the interest rate. The important thing in here, and this is a protection for y'all, your promissory note lists the maximum possible interest rate. I never thought I'd have to be emphasizing this, but have you looked at mortgage rates in the past 3 months? Dear goodness. I mean, we're kind of moving back to what they were in like the 1960s, where they were like 19% on a mortgage. We're not that bad yet. We're like 7.5% right now, even if you've got really good credit. Whereas 2 years ago, they were at 2%. And you're going, well, that doesn't sound too bad. It's awful. It really is. So the important thing for y'all, never thought we might even be getting close to this, but here we are. If you borrow, your student loans will never go above 9.5%. Now, what does that mean for the loans you already have borrowed? Absolutely nothing. You've got them. They're at fixed interest rates. Those are fine. But for future loans that you may borrow, you know they'll never be above 9.5%, which is what I used to use as the scary number for private loans, when people would be like, hey, Casey, I'm thinking of doing a private loan. I don't think I want to do one of these Grad Plus things. No. Well, now we're looking at this. So, hey, we've done 3 of 14 pages. Don't worry, we skip a lot from here on out. All right. Key things on page 4, if you're wanting to follow along. You have the right to cancel your loans up to the point it's dispersed. So when I'm saying hey, go ahead and put it out there. You can cancel it right up until it's dispersed. Borrow for the fall. If you don't think you're going to need it for the spring, still leave it out there for spring. We can cancel it up until the money's in your hand. And then, of course, going back to what we talked about earlier, you still have 90 days after that to actually give it back to us and get credit for having never borrowed it. How you get your funds, that's in there. That just shows that it doesn't go directly to you, like a lot of students think on their way into school. It actually goes through the school, pays the school first, and then goes to you. Grace period, not grade period. Typo. That's the 6 months after you graduate or stop attending at least half-time, which at the University of South Carolina is defined as 6 hours. If you say we're to take a year off and do a PhD or 2 years off or something like that, there are provisions that allow schools and different programs to let you be less than 6 hours and still be considered half-time or full-time. Typically doesn't apply to y'all, but if you find yourself in one of those situations wanting to go do a PhD or something like that, come talk to me. We'll talk through the ramifications. Repayment, you can still sign up for tomorrow. I can increase my count on the food. So it's on the same link that you signed up for today. And then default. This is the one thing you don't want to do, but it legally means you haven't made a payment in 270 days since a required payment. So you're almost through a whole year you've missed, and now you're officially in default. Guess what? Good news. The federal default rate right now is effectively 0, because guess who hasn't had to make payments in 3 years? It also means that when repayments start, we get a good 3/4 of a year before any school's ever going to show any default. Doesn't really affect y'all so much. Doctors default on their loans, all loans kind of together, whether it be your houses, your student loans, your any private loans, any practice loans and things you have, any car loans, you all default less than 1% anyway. That's why you get preferential rates and programs and don't have to go through the same level of underwriting that the rest of us poor peons do. Sorry, the rest of us have higher default rates. It just is when you look at the demographics. And then acceleration. This is the scariest thing on every single loan application or loan form I have ever seen. Thankfully, there are very limited times when it could happen. What acceleration means is you screwed up. Give us all the money back right now, plus the interest, plus any fees. That pretty much only happens in cases of fraud. And I've never, even in cases of fraud, I've never known the federal government to come down and apply this statute. Doesn't mean they can't, but it's in there. Another reason you want to make sure you don't default and don't defraud the government in this case. All right, it's page 4. I'm sorry?
Back one. For acceleration, it says limited to.
Oh, overpayment means that the school gave you too much money, so they can ask back from you the overpayment. Not that you overpaid. They'd be like, sure, but they actually give the government credit on this. Their servicers are pretty good about giving you the money back if you overpay them. But anyhow, failure to enroll is one we see pretty often. Like, let's say you're coming to, actually, I've got an example. We never actually dispersed the students' loans because they let us know just in time. In our second year as a school, we had a student who was slated to come to school. The day before orientation, the student calls us and said, hey, y'all, I just sold my app for $2 million. I'm going to go focus on this thing, sorry. Yeah, it was an interesting situation. Like, kudos to that student. Still remember his name and don't know if he ever released anything else because his name wasn't even on the first app. But we were at the point of dispersing that student's financial aid. Had we dispersed it and he failed to enroll, the Department of Ed could have enacted the acceleration clause. That's what that one means. All right, or that if you use the funds to buy a car or go to Vegas or any number of other things that are not outlined in the legal definition of a cost of attendance. Has it ever happened for any of the last ones I said? No. The good thing is money is fungible. So if I've got money here and money there, it doesn't really matter where I use the particular dollar from which account. So you can always make that case. Like if you're borrowing to free up money in your other accounts to buy the car. Putting it in quotes. All right, the last bit of it, page 9, item 13. The use of loan money. This is more of what I was just talking about. It's the list of items actually in the cost of attendance. It's in a section that's actually part of the borrower's rights and something. It's the BRR. I can't remember what the other R is in this document. And it's the same list that we use on our cost of attendance. I may, on our cost of attendance, actually compress some of those so it fits on the website better, looks better. And we're seeing some changes on this. For the first time in a while, the Department of Ed has made some changes. They've said what we have to call certain things. So like instead of your room, it's now called housing. Instead of your board, it's now called food. Because apparently room and board got too confusing for people. It's Congress. They keep saying that these things are too complicated. But all of that's out there. They also did make some changes. So for those of you who are still going to be in school with us next year, first, do the survey. You all should have gotten a survey on the 3rd of January. I'm going to say this until I'm blue in the face. Do the survey. Because if you do, you can actually see changes in your cost of attendance. I've noticed over the years, more and more of you coming to me being like, Casey, I'm really borrowing at the cost of attendance. What can I do? This is one of the things you can do. I'd love to get your spending down, but I'd rather you also have a big cushion in there. So fill that survey out honestly with what you're actually spending, not with what you tell me you spend. I know you do it. So fill that out, get that done, submit it. There are also going to be some changes within the next year to where instead of being, the food section being on 16 meals a week, not a day, 16 meals a week, it's now based on 21 meals a week because the Department of Ed said, hey, We're telling people to eat 3 square meals a day. Why are we not giving them money for that? Who knew Congress actually had a brain? Sometimes. Anyhow, all right. I'm really down on the Congress right now. So, all right. All right. Page 10, 10 and 11, it kind of goes over this. Loan repayment options. Again, we're going over this tomorrow. Show up tomorrow. We're going to hit all those. Page 12, item 20, deferment and forbearance. What if you can't make payments? What if, and this has happened once in the entire history of the medical school. I had a student who had extremely high expenses, placed in San Francisco, could not get one of the housing that's provided by the hospital in San Francisco because they had a pet and were single. And they just could not even afford an income-driven repayment plan. And it's like we were going through a million different scenarios. And eventually, this is the one time I've advised a student, like, look, you simply can't afford to make payments while you're in residency. This is going to cost you a lot of money, but hey, you rank San Francisco number 1. Really? Sorry if that's your favorite. It's the most expensive city in the country. Anyhow, so this student, I advised them that, hey, you have access to a guaranteed residency forbearance. So that meant that they could say, hey, I'm in medical residency. Please don't charge me my student loans until I'm done with medical residency. And they have to accept that because it's guaranteed. So that's the type of forbearances and deferments and things we're talking about. If you want to know the difference between them, a deferment is generally that if you have subsidized loans, they're not going to charge you interest on those. Unsubsidized loans, they always charge you interest, in deferment or out of deferment, doesn't matter. A forbearance means they're going to charge you interest on sub or unsubsidized loans. That's the only difference between them. For medical school loans, they operate exactly the same, so it doesn't matter which one you're in. Right now, you are all on an in-school deferment. It's a guaranteed in-school deferment. They don't even make you request this one. It's just given to you, as long as you're enrolled at least 6 credit hours. Take a leave of absence for more than 6 months. You've used up that grace period. You would normally re-enter repayment. Well, guess what? Right now, we're in an administrative forbearance. There's that word again. Different situation. No one's having to make payments right now. And unlike the normal, no one's being charged interest right now, which we're good with. All right. Important thing, and this is the pages 12 and 13, item 21. This is probably the most important reason why you should all save copies of your promissory note. I'm not saying the government's going to lose it in a boating accident, but this is your protection. If you are at all interested in public service loan forgiveness, it is guaranteed, codified into law, and on your promissory note that you signed and entered into a contract with the federal government on, that they are to offer you the option of public service loan forgiveness. That after 120 payments, qualifying payments, in particularly outlined repayment plans that are on that section, they will forgive everything left over. That is your protection. Even if they cancel it, that is your protection. Now, would they likely do anything and cancel it for those of you already in school? Probably not. I'm not willing to rest $200,000 on that. I'm going to cover my own tail. So, that's probably the most important thing and why you need to keep a copy of this. Like all your obligations to them, if they lose that, hey, I'm good with that. You lost my obligation to pay you back? Okay, bye. You saw this actually happen, not with student loans, but you saw it happen with mortgages a few years ago during the big housing crisis, where they couldn't even say, here's a copy of the mortgage you signed, because they had been sold and broken up, and they couldn't say who owned a mortgage. And some people, in the middle of this housing crisis and all the foreclosure crisis, actually got their own homes free and clear. It was rare. It was hard to prove. But no one could produce that the person actually owed them anything for the house. They just had a document saying, I bought this debt from somewhere, but they couldn't prove anything else. Government's a little bit smarter than that. Have to give them a little bit of credit. So, if they lose it, your obligations, that's great. But if they lose their obligations to you, it can only benefit them. So keep a copy. Page 14, you can read it. It's really boring. It's just like, oh, well, these are on these items. These are these items. And this is how you fill out a form that asks maybe 5 questions. Well, that's the promissory note. What questions do you have about kind of what you signed and how you signed your life away? All right.
In terms of like paying back your loans you don't have a problem with. How often, like, what are the plans usually for trying to pay back your loans? Just obviously,
Yeah, so
it's gonna be like 20 years to like pay it all back, or
So if you're not doing public service loan forgiveness, how do we do it? Generally speaking, we would probably put you in an income-driven repayment plan while you're in residency. That's just a matter of practicality. Those are the payments you can afford, and it stops interest from capitalizing. Likely, it's going to be pay-as-you-earn or revised pay-as-you-earn. Come back tomorrow, I'll tell you the difference between those. And for individual students, that's where it varies. Oddly enough, I don't tend to have students leave those programs if they're going to get more aggressive and repay these student loans and not do public service loan forgiveness. I'd have you stay in that program and just make larger payments. Because that's one of the other clauses we didn't talk about in here. There's never a prepayment penalty on your federal student loans, whether it's you're prepaying interest or you're prepaying principal. There's no penalty to that. It can only advantage you theoretically. But yeah, we tend to keep you in that same plane you start in. Because another capitalization point is anytime you change a repayment plan, they capitalize your interest again. So if we can avoid that, I'd rather it stay interest, even if it's sitting out there as a chunk of money I've got to pay.
but if you pay your outstanding interest, there's no capitalization.
Oh, yeah. If you've already paid all your outstanding interest, then you've got nothing to worry about. But generally, people are thinking of doing that right out of residency, and most people haven't paid all their interest off at the end of residency. You haven't. Sorry. Unless you're married and your spouse makes all the money. Had that happen a few years ago. All right, what other questions?
Start on the 10-year public loan service forgiveness and residence.
Yeah, so the question was, can you start on public service loan forgiveness, the 10 years worth of repayments in residency? The answer is both yes, and you absolutely should. Because when do you make more money, as a resident or as an attending? As an attending. So if I can get credit during my time of making, I'm not going to say it's no money. It's actually y'all still as residents make higher than the national family average. But, hardly. But I mean, that's the family average, not individual average. We're not counting it by how many hours you actually work. That's a different thing altogether. No. Y'all by all means do that if you want to be depressed. I'm just talking about yearly wages. So while you're not making much money as a doctor, you're like, hi, I'm Dr. So-and-so, and I make a pittance. Sorry, I have a dark sense of humor. You're wanting to make payments that qualify for public service loan forgiveness because they're all in income-driven plans. And if my income's lower, and hey, I want to tack on a fellowship. By the way, I love fellowships when y'all do public service loan forgiveness. Any neurosurgery people in here? Like, that's not that you should choose your specialty because of that, but that's like the highest salary once you're in attending and the lowest repayment ever with public service loan forgiveness because their training's for 10 years. They're residents and fellows for 10 years, and they basically pay off like $50,000, $60,000 worth of their total debt, and then the next year go and make $500,000 at least. Extreme example. But still, $500,000 is kind of on the low side, isn't it, these days? Yeah. We're probably, no, 900,000. I'm sorry, that's what the average starting salary was a few years ago. It's since dropped off my list because not enough people were going into it. All right, any other questions?
What types of hospitals, like are all MTEL hospitals,
Are all what hospitals?
like,
You're going to have to define that. Okay, so what types of hospitals qualify for public service loan forgiveness? All publicly funded ones, yes. Most privately funded ones, yes. The key aspect that makes it eligible for public service loan forgiveness is that it is either a government institution, so MUSC is an example of that. They're run by the state. Everyone who works at MUSC is a state employee, and that's why if you look up on there, you can see all of the salaries of every doctor at MUSC by going to the state salary database. Anyone who makes over $50,000 in most states, you can usually see their salary online somewhere. So, that's an example. The second option is you can be a nonprofit hospital. So, Prisma, not exactly publicly funded anymore, it's private, but they're nonprofit or not-for-profit. I forget what the difference is and which one they are. But it doesn't matter because they're both treated the same under the public service loan forgiveness. So any of those. What doesn't qualify? The hospital system in Myrtle Beach is privately owned and for-profit. HCA. That's the ones I couldn't remember. That's like Asheville is an HCA hospital. So those don't qualify. If it's, hold on. If it's an HCA hospital and you're working there as an attending, I guarantee it doesn't qualify. If, on the other hand, say you go to Asheville for residency, you're working at HCA hospitals, but the residency programs in North Carolina are run by the state. So you have MAHAC, it's the Mountain Something Health Education Consortium. And so our students that have gone there have actually qualified for public service loan forgiveness through their time in residency, assuming they got a job elsewhere afterwards. So you've got to kind of look that up. And here's the thing. It's an easy Google search. You just is such and such hospital nonprofit? Because guess what? These nonprofits love to put it out there on their website. We're a nonprofit hospital. We gave away this much money in services last year. Blah, 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 blah. By the way, what they gave away in services means they couldn't collect on. So they wrote it off. That translating the business speak. No, they do actually have great charitable organizations. I mean, I have friends that have been beneficiaries of them. But generally speaking, if they're saying we gave it away, they just couldn't get someone to pay for it. Anyhow. All right.
Is there a reason why someone would?
Is there a reason you wouldn't do it? So one of them is if you are particularly low debt or particularly high income, then that might be a reason why not to. And those are the monetary reasons. Like when I put it on paper, it might just not make sense. Those are actually a little bit more rare. I would say there's also the matter of personal preference. Some of you just don't want to be in debt for 10 years, even if it can save you a little bit more money when you could pay it off in 7 or 8 years. I pick on them, but everyone going into emergency medicine, you've got the shortest possible residence with the highest possible pay after residency. Or at least it was a few years ago. It's started to change a little bit.
Somewhere?
Damn. I still have 5 minutes. No, I'm kidding. If you got to go. But no, if it could be a matter of personal preference. There's a few students, or maybe it's close for public service loan forgiveness versus paying it off. If it's close, I might pay an extra $5,000 just to be out of debt a whole lot faster. But that's me. That's not necessarily you. That's why we've gotten back to doing those end-of-year counseling sessions, which if you haven't, sign up for yours. Except for the M4s, y'all have to wait. Do I think it's worth it if you're going to be in residency for 5 or more years to do PSLF? Most likely. We'd have to look at your salaries and your debt numbers and everything, because it really is a highly individualized question. But most likely, if I'm looking at kind of averages and things like that, you're at a 5-year residency, it's probably worth it. All right, any other questions? Yeah? When do you officially opt into public service loan forgiveness? I don't want to scare you with the answer, so I'm going to start with the easy part that hopefully sets your mind at ease. You opt into your repayment plan that qualifies for public service loan forgiveness as you're leaving medical school. And actually, in most cases, I have students go directly into repayment. We'll have you consolidate and enter repayment immediately, not even take your 6-month grace period. We do that so we can get a $0 payment the first year. Your question, the answer to that is you don't actually request public service loan forgiveness until you've reached 120 payments. That said, now that I've scared you again, there are checks along the way. Every single year there's a form you do and it gives you a checkup. And it's like, hey, you're up to this many qualifying payments. Hey, your employer qualified. Hey, this payment was late. And you're like, no, it wasn't. And you go back and you prove that it wasn't late. They'll fix that. So you're checking up every single year, making sure that you're on track. So it's not like you're 10 years with no notice whatsoever. That's actually what happened to the first borrowers and people requesting public service loan forgiveness. Well, financial aid community, we told them early on, like, this is going to be an issue. They need to know they're on track on the way. And that's because a lot of us were in that program. Like, hey, we really want to know where we are on this because, we work for the state. So they started doing that. And they've gotten pretty good at it. It's actually not a bad thing. When you get to fourth year, come to my Idiot's Guide to Public Service Loan Forgiveness talk, and we go over like how to download these documents, how to submit them, what they look like, and all of that good stuff. Yeah. All right, other questions? Hearing none. Anyone actually learn something today? You learned something about your promissory note? You learned what you signed yourself up for and then signed your soul away for? Good. All right, I've got one light left. Whoever wants it, come grab it. Thank y'all.